Thank you for joining us tonight. I'm really happy to be hosting once again this market update, kind of our money and markets bi-monthly call. So I appreciate you taking the join us. And I'm excited tonight because we have a guest with us. So I have Jason McKinney, who some of you may be familiar with and have seen before, and he's a senior vice president at John Hancock Investments with Manulife. He has been with the company for 24 years. I was just thinking today that I graduated from college 25 years ago. So I don't know how this is happening, but here we are. So congrats on that. That's a good long run. He graduated from the University of New Hampshire and he lives in Londonderry with his family. And we were just chatting prior to getting on the call that one of the things they enjoy as a family is heading up to Lake Winnipesaukee. And he's actually there right now. So thanks for joining us, Jason. I really appreciate it.
My pleasure. Thanks for having me.
So we're just going to kick it off tonight. I know I was curious if you could talk to us a little bit about some market updates. And then a lot of the questions I've been getting have been surrounding, is the market still too high to invest? Is it, is it too bumpy to invest? Should I wait? And so if you could also cover that. And I know you and I talked a little yesterday, but yeah, just covering some of those topics and really the concerns people have with different geopolitical events and such that are going on.
Sure. Yes. Happy to. Well, it's certainly an interesting time, and we've benefited economically by becoming a intertwined global economy over the last couple of decades. The drawback to that, though, is with us all so intertwined and relying on each other's economies, when there are tensions, be it wars, when there are recessions in other parts of the world, when there are tariff tantrums and battles, that poses a bit of a risk. Way back in the day, it didn't matter so much what was going on in the rest of the world. Our economy didn't really care, and the citizens of our country didn't really know what was going on as well as they do now. And so I guess it's a blessing and a curse with the 24/7 news cycle and technology. And it's got some benefits, but it also has some drawbacks. And one of those is it does distract us a lot. There's a lot of noise out there, and that can lead to challenges from investors that have always been going on. We have a great presentation called History Lessons, and it looks back over the last 100 years of the market, and it shows that pretty consistently investors have constantly failed themselves because they've gotten too emotional about their investing. We like the saying that you should use logic, not emotion, when making investment decisions. And I know that can be easier said than done, but if you look back at the history of the markets, you will notice that oftentimes during stressful moments, the investors bail at a much higher rate on their investments and on their plan. And the problem with that, of course, is they're not there to benefit from the inevitable recoveries that have always happened. And so with what's going on right now, it's more of the same. It's just a different type of noise or a different type of distraction, right? The news cycle, it's interesting. It will push some things to the forefront, and then after a few days or a week, that will disappear for a while, and they'll find something better to talk about, right? But a lot of those things haven't gone away that we've been hearing about, be it Russia and Ukraine, that's now been going on for, I believe it's about 3 years. The most recent stressful thing going on, of course, is what's going on with Israel and Iran. Remember, maybe a month ago, it was India and Pakistan, right? So you never know. It's like the weather in New England. Just give it a minute and it will change. So the important thing about everything that's going on, in our opinion, is that we came into this year on really solid ground as a U.S. economy and as a U.S. investor. With all the geopolitical concerns and with the uncertainty with tariffs and what's going on in Washington, D.C., there is reason to be concerned because the markets don't like uncertainty. Decision makers don't like uncertainty. But as I was alluding to, we came into this year on really solid ground. A couple ways to share that with some facts behind it is net worth. I know you're all on this call probably very familiar with that concept. For those that aren't, you take your assets and you subtract your liabilities, and that number is your net worth, right? And the good news is, coming into this year, the U.S. citizen had its highest net worth in history. And that is inflation adjusted too. So some people might say, well, of course, because, 50 years ago, people made $5,000 a year, not what they make now, but that's adjusted for inflation. So it's important to know that with net worth as an average across our entire country being at an all-time high, that is good for what we refer to as the wealth effect. If you open up your statements and you see a large account balance in your 401k or your IRA, or a nice account balance in your bank account, checking, savings, or if you do pay attention to your net worth, as people should, you're going to feel better and feel wealthier. And the importance of the wealth effect is that you might watch the news and you might see all of those scary things going on, but in your little world, you're doing well, your family's doing well. So as much as none of us like to see all those things going on out there, if we feel like our family is doing well financially, because, for instance, we know we have our highest net worth we've ever had, we're more likely to take the family out to dinner that night, or we're more likely to upgrade that TV or that vehicle, or consider buying that second home. So the highest net worth in history is one important factoid that helps us feel okay about getting through the current mess that we're seeing on the news every day. The other factoid is this. There is a data point that is accurate, but a little bit misleading. And the data point is that credit card debt is at an all-time high. And that's technically true. Credit card debt is at an all-time high. But more importantly is the percentage of your take-home pay after taxes that you then have to use to service that debt. So an example of why credit card debt is at an all-time high is there are more people on planet Earth now than there were, say, 20 years ago. And that means there's more consumers on planet Earth now than there were 20 years ago. So that also means there's more credit cards on planet Earth than there were 20 years ago. Not to mention, in addition to credit cards, there are things like Apple Pay and Venmo and PayPal and all these ways to buy things online right now. And even though the thing online only costs $39.99, you can pay for it in 4 payments, right? And so those things are all technically debt. And so because there's more people on Earth and there's more credit cards on Earth, naturally there's going to be more spending and more usage of credit cards. Let's also keep in mind that things cost a lot more than they did 10 or 20 years ago because of inflation. So I'll give this example. If you took a family of 4 to the movies 10 years ago, it might be $8 for the ticket and $4 for the popcorn. So $12. And you got to get everybody popcorn, right? Who doesn't like popcorn at the movies? So that's 12 times 4, that's $48. Well, 10 or 20 years ago, you might have brought to the movies your wallet or purse, and in there, you knew you were going out for the night with the family. You might have 3 $20 bills or 4 $20 bills. So you pull out $60 and you pay the cashier. They give you your change and you walk into the movie. Well, now today, if you go to the movies, I don't know if you've gone recently, but my daughter just went with some friends the other night, and the movie ticket was $16. And who knows how much all the candy and other things were. But let's just say that it's now twice as much as it was 10 or 20 years ago, the popcorn, the movie tickets. So instead of $48, it's $96. Are you bringing $100 in cash to the movies? No. Right? So you're more likely to use a credit card to pay for that movie. So because things cost more, and because the convenience of technology and using cards or Apple Pay or Venmo, more people are charging things. So yes, credit card debt is technically at an all-time high. But back to the more important point, what percentage of your take-home pay do you then have to use to turn around and write a check to Capital One or whoever that credit card company is to pay off or down that credit card debt? And that is near an all-time low. So that is another good data point that makes us feel that as much as we all hate what's going on in the news, we hate the uncertainty that tariffs bring, especially if you're a business owner trying to make plans for 6 to 12 months out. It's hard to say, I'm going to hire 4 more people, or I'm going to build another warehouse if I don't know exactly the impact of tariffs on my business in 6 to 12 months. And then, of course, all the situations going on with war and the concerns of that. But again, if all this stuff were to happen, which it always seems to, there's always something going on, and the media makes sure to remind us of that, things that do stress us out, at least we came into this year on really solid ground with the highest net worth ever, and with a low debt to income ratio. So those are some things that make us feel a little bit better. All right, so a couple more points, and then we can move it over to some questions. It's not great for everybody, obviously. The averages are good. The average net worth is at an all-time high. The percent of your take-home pay you have to send to pay down your debt is near an all-time low. But there are, of course, areas that are struggling. One of the things that we did is we took the wage earners across the country and we took every single wage earner and broke them into 5 quintiles, 5 buckets, 5 20% buckets. And what's important to note is that, not surprisingly, the bottom 20% of wage earners are the ones that are struggling the most with things like credit card debt. They don't pay their credit card off every month, unfortunately. And credit card debt or credit card interest rates are now 30% in some cases. So that's hard to dig out of. The cost of eggs and food and all that, of course. And think about the folks in the bottom 20% of wage earners, which, by the way, is below $50,000. They probably don't own a home. They're probably renting. And if you own a home, you've probably noticed that in the last 5 or 10 years, your monthly payment has not gone up, right? If you bought a home 10 years ago and got a fixed rate mortgage, as most people do in the US, well, that number that you pay every month in your mortgage and interest payment is the same.
Mm.
It's the same this month as it was 10 Junes ago. And so with your wages increasing over the last 10 years, the actual cost of your living situation is probably lower than it was as a percentage of your take-home pay. But if you think about the bottom 20%, they're typically renters. And unfortunately, and you've probably heard about this in the news, rents have been going up dramatically the last 5 years. And I mean, it's the prerogative of the landlord to raise the costs, right? They have to deal with other inflation situations themselves. If they have to fix the toilet and the sink, well, the plumber's charging more now to fix the toilet and the sink than they did 5 years ago. So the bottom 20% renting mostly, that makes it challenging. So dealing with inflation, dealing with the cost of living, dealing with credit card debt, it makes it challenging for obvious reasons with that group particularly. Here's the good news economically with that. Nobody wants anybody to struggle. But if there was a group, a quintile that were to struggle, the economy would prefer it be the bottom 20%. That's probably not surprising to you, but I'll share a statistic on why, if any group were to struggle, economically speaking, it's best for the economy that's the bottom 20%. And that's because the bottom 20% of wage earners only make up 8% of consumer spending, which is probably not a big surprise. The top 20% of wage earners, they make up over 30%. So another way of saying it is the top 20% of wage earners, they make up more spending than the bottom 40% of wage earners. So that is a challenge. And so what we need to be watching about or watching for in the coming months is, does the uncertainty of tariffs, does the uncertainty of the geopolitical concerns that are going on out there, does that lead to enough concern and uncertainty that we see a waterfall effect where the bottom 20% is not doing great? Does that then spill into the next 20% and so on and so forth, right? But for now, the top 60% is doing great. Even the next 20% is not doing too bad. And those are the ones that are driving the bus of the economy, so to speak. And our economy is 75% consumer spending. So when you hear things about recessions, when you hear things about GDP, gross domestic product, for us to go into a recession, we need a big slowdown in spending, because our GDP, which is what's tracked to determine if we're in a recession, our GDP is 75% consumer spending. And so because the average consumer across the country has their highest net worth ever, and the average consumer across the country has a lower income to debt ratio than they've had in a long time, we're able to withstand that right now. But we don't want this uncertainty to continue. So hopefully they can figure things out with the tariffs. Hopefully we can get some peace talks and all get along. So that'll make it a lot easier for the entire 100%. So I'll pause there for now, Jen.
All right. Yeah, it sounds like fundamentals are pretty good, but there's just this uncertainty that's really causing some of this shorter term volatility that we're seeing in the markets. And I know clients had been really concerned with inflation, but we've seen that come down. Rates have kind of stabilized. Do you think that we are in for that soft landing? Any thoughts there from the bond side of things?
Yeah, inflation's a tricky one right now because the Federal Reserve, whose job it is to watch these things, they're looking at inflation, they're looking at unemployment, and they want to find the happy medium. They don't want there to be too much inflation, and that's why they raised interest rates. But at the same time, they don't want to keep rates too high for too long because it makes it more expensive for people to borrow, right? And if it's more expensive to borrow, people aren't going to spend as much. And so they've got a really tough job right now. And then when we think about some of the situations out there in terms of the impact on inflation, there's a concern, of course, that tariffs can have an impact on inflation, and that is true. You also have the unrest in the Middle East, which can push up oil prices. So that's something that we need to watch as well. But for the most part, inflation has been slowly moving down. One example that a lot of people in New England don't notice, because our real estate markets remain pretty strong, is that there are a number of parts of the country that their real estate markets have been softening. If you think about during COVID, a lot of people moved because they could work from home. A lot of people moved to places like Austin, Texas, Nashville, Tennessee, Florida. Well, those places are really struggling right now. They're losing a lot of people back to office, if you will. A lot of folks that were able to work from home, their companies are now saying, okay, it's time to come back. You've got to at least be in the office 3 days a week. Well, if someone had moved to Austin, Texas, and their company's headquarters are in Chicago or New York, you can't go into the office 3 days a week living in Austin, right? And so some of the biggest challenges in the real estate market right now are ironically some of the hottest real estate markets from the past 5 years, like Austin and Nashville. Florida's having a lot of issues, partially because of the continuous natural disaster challenge, which has pushed up the cost of insurance, which is pushed up the cost of HOA fees, right? And Jen, you know a little bit about that,
Yes,
right?
I'm in it.
From your
Yeah.
situation.
Yeah.
So
Yeah.
those are some of the things that we need to be watching in terms of inflation. But it has been coming down. It's come down to around 3%, which is a much more manageable and comfortable number, which increases the likelihood that the Fed will continue to cut rates. I say continue to cut rates. A lot of people don't even remember that they started cutting rates over a year ago. They have cut rates by about 1%. And they're going to continue to watch the data. And if inflation continues to move down, there's a good chance later on this year they may start to cut a little bit more, because the Fed does acknowledge that what they would consider a neutral rate for the Fed rate, which is somewhere in the low to mid fours right now, they would admit that a healthier number for the economy is around 3% for a Fed funds rate. If a Fed funds rate is 3%, that usually equates to a mortgage rate of about, say, 5%. And that equates to a car loan of maybe 7, and credit card rates of much lower than they are now. So that's the goal, and that should help the economy. So the inflation numbers are heading down, but they've been stickier than we've thought they would be, I believe, everybody. And so that's something worth keeping an eye on.
Good information. And sometimes this volatility and this uncertainty also creates opportunity. I mean, when you think about if you've been wanting to go to Florida or Texas or any of these states that are having trouble, it could also be an opportunity. So it's always good too to try to view things in different lights. Does anybody have any questions? I have several I'd like to ask Jason, but before I continue on, I wanted to see if anybody from the audience does. And if you do, you're able to go down to the bottom of your screen, and where it says react, you would click that, I believe, and you can raise your hand. I'll just give it a minute.
Sure. How is your home doing while we're waiting, Jen, if you don't mind me
My
asking?
home
The
is
Florida home.
still not done. Yes, so we're experiencing that firsthand. Our condo in Florida it was flooded during Helene, for those listening who don't know. And we had to cut 4 feet down on the walls. The floors have been removed, the cabinets have been removed, the toilet, the shower, everything. And we are now sitting at about 9 months since the storm. And there has been no progress. So, to your point, we're paying condo fees. There's going to be special assessments on top of that. The roof needs to be replaced. Insurance has become a problem. So you have those condo fees driving up, as well as the special assessments. And then if you want to sell, so the reason things are going less expensive is because many times you have to be a cash buyer to go in to get a mortgage until some of these things are all repaired. So yeah, it's
It's a good point.
Very interesting. So yeah, no, not good, but all right. Well, I will go and just ask you a few more questions then,
Sure.
because I
Great.
had a whole bunch of things I wanted to chat about. Um, so as things are volatile, right, clients can become very uncertain, and I have a lot of conversations with them. And so Jason doesn't work with clients. Jason works with financial advisors, and so as working with financial advisors, I'm sure you hear all kinds of stories and are front and center to many of the reactions to the market. So, what would you say would be a mistake that we can caution investors against during times of uncertainty?
Sure. I mean, I think I alluded to it briefly earlier, but trying to separate emotions from your finances, there's a great one-liner, which is facts versus feelings. And our chief market strategist, she was on CNBC recently, and she shared that because it's easy for people to let their feelings get in the way always and for decades and decades and decades. But it seems even easier these days because of how divided the country has become politically. And because we, again, get to see more of the awfulness going on around the world because we kind of can't get away from it. It's on our phones, it's on everything. So facts versus feelings is essentially saying, hey, feelings are natural. We're all going to have feelings, and you can have those feelings, but don't let them get in the way of the facts for your financial situation. And I think facts versus feelings is a good one. And I said earlier about history lessons, which is one of my favorite presentations. And we look back at history, and it's sad to see how often people got emotional and bailed. But what's interesting is they tried to hang in, and they usually don't bail until after they've realized the big drawdown. And then they sell, and then they exit. And then because they're so scarred and burned, they're not open to getting back in anytime soon. And I give a couple examples. So one of the most well-known would be the global financial crisis, which started in October of '07, and the bottom of the market was in March of '09. So it was about a 16, 17 month drawdown. And from the peak of the market in October of '07 to the trough, the bottom in March of '09, the US stock market lost 54%. Now, a lot of people talk about '08, that was the worst, and that was a full year. The others were partial years, but in '08, the markets were down 37. So sometimes people correct me and say, no, the markets were only down 37. Actually, 54 if you go from the top to the bottom, late '07, early '09. Now, thankfully, those that are students of investing or work with financial advisors, they're not going to just own the US large cap stock market. So they're going to have diversification. They're going to own bonds. They're going to own maybe some other alternative asset classes. And so if you were in, for instance, a 65-35 portfolio over that same period, instead of losing 54%, your portfolio would have been down 25, which still is not fun. But if your brother-in-law is down 54 and you're down 25, that's kind of fun, right? Because you get to give them a hard time, and I'm only down 25. So, but I'm joking, but I'm not, in that the challenge is, if you look at the history of that experience, the largest amount of outflows, that's a fancy term for people selling out of the market. Their assets were flowing out of the market into their bank account and into CDs or cash money markets or under their mattress, right?
Mhm.
Things like that. So the largest amount of outflows occurred in February of '09. And the reason that's so sad, as I said earlier, they wrote it all the way down. They felt bad, they felt bad, they felt worse. And then they waved the white flag after the damage had been done. After the equity markets were down 54, the balanced portfolio they were in was down 25. And that's when they got out. So they locked in that loss, because you don't lose anything until you sell, right? And a good example I'll mention of that real quick. For those of you that don't own a home, you might recall during some of the real estate downturns of the past 20 years, you might have got something in the mail from the town saying the assessed value of your home was now only X and it used to be Y. Well, you don't really care because you're not selling your house, right? So it doesn't really matter to me. And in fact, not only am I not selling my house, but I redid the bathroom and I put on a new deck out back. So that piece of paper says it's worth less than it was 3 or 4 years ago. It's actually worth more, and you probably know that. But anyways, the point here that I'm trying to get across is that they got emotional. They waved the white flag of surrender. They got out of the markets. And then they were so scarred that they went into something that could not give them the ability to make back what they lost. And so even though the markets, this is a crazy stat. So the market went down 54% from October of '07 to March of '09. That's the S&P 500's return. From March 9th of '09, which is when the market bottomed, the S&P 500, when I say the market, from March 9th of '09 to the end of that year, so that's about 10 months roughly, the S&P 500 went up 68%.
Yeah.
So it took 18 months to drop 54%, and then it went up 68% in the last 9 months of 2009. But a lot of investors, I'll put a number on it, $1 trillion worth of investor money left the market in February of '09. And that $1 trillion went into cash, CDs, or under their mattress and missed out on that 68% return. So that's the biggest culprit to investing success is our own, hearts and minds. And then I will say one other thing just to pile on to the frustration of behavioral biased blunders, as I call them. You would think that people would have learned from that, right? And there's that saying, if you don't learn from history, you're bound to repeat it. Well, now I'll use an example of during COVID, and I know we were all shocked and scared. We'd never experienced that. We weren't sure what to expect. And so maybe it wasn't surprising, but guess what? A new record was broken, and not the record you want to be known for. In March of 2020, there were more outflows from the markets in March of 2020 than there were in February of '09, which was the previous record, and by almost 50% more. So the markets dropped from late February to late March of 2020 during COVID and all that uncertainty. The markets dropped, the S&P 500 roughly 34%, and we saw close to $2 trillion this time. It's like 1.7 trillion, I believe, depending on if you include March and April of 2020, left the market, just like they did during the global financial crisis. And guess what happened? Similar situation. The markets, when they started to hear that there was scientists working on a treatment, a vaccine, when they heard that the government was stepping up to help people forgive loans and other things, the markets started taking off. And a lot of people, millions around the country, said, whoa, 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 hold on. I just sold out of that thing. And now you're telling me it's up this much. So history repeated itself, unfortunately. So in summary, the biggest challenges continue to be, and probably always will be, the what I call behavioral biased blunders that so many people succumb to. And that's it's too bad. It's a shame, which is why education is so important.
I completely agree. I think, all the questions I could have asked you right then kind of led down that path. And that
Right.
is one of the biggest things I see from my seat as well, is that temptation to react. And I think it's normal and I think it's natural, and, we're human and we are also tend to forget, right? And we feel our emotions really strongly, which is absolutely okay and we should. However, it is not conducive to staying invested. So I think it's important to remember when you start investing that it's going to go down. There's going to be a day it goes down. We've had
Yeah.
one pandemic, we've had one 9/11, we've had one 2008 that was that same exact set of circumstances, and everyone says it's different, and it is different, and it's not likely we're going to ever have again the exact same set again. It's going to be something else, and it's going to feel scary and it's going to feel hard. So that's why when we're building portfolios and talking about diversification, that we're really looking at, okay, it's going to go down, and we're asking, how would you feel when it goes down this much? And not just percent, but dollars. Like, how would that feel to you? And if it's going to feel too much, it's more important that you have a strategy that you can stay in through those hard times than that you're in one that's going to go, break glass ceilings in an up market, and then you're going to want to sell down. You're going to have a better return by staying in a strategy that works for you. So I think that for me is my version of the takeaway in terms of like working with clients. I think it's really important to find a model, whether it's 60/40 or 80/20 or whatnot, that you're comfortable with, that you can commit to staying invested. And if you have questions, pick up the phone and call someone, call me, as your advisor. If you have a different advisor, call them, but have that conversation, because it's very, very important that during times of volatility, those emotional decisions are not made. And then maybe after the recovery, it's time to have a conversation again and revisit diversification. Maybe this wasn't the right model and this is why, and talking about how that felt. So I
Right.
appreciate
Yeah.
the time.
Yeah, absolutely.
So I have one question that I actually had asked my podcast guests, and I'm curious, what is your favorite book? It doesn't have to be about investing, and why?
Oh gosh, favorite book. I do read often. I've got in my bag here to read on the boat, a novel, and I would say my favorite is a series of books from Stephen King, and it's not the ones that are known by as many people, but it's called the Dark Tower, and it's kind of like a almost think of like a Western type of Clint Eastwood type of deal. And the main character is called Roland. Name is Roland, and he's known as a gunslinger. And it's like so picture Clint Eastwood in those movies back in the day, but this takes place almost kind of in a post-apocalyptic world, and it's just very different than anything else. And I'm one of those people. I like to read things as an escape, and
Yeah.
I've really enjoyed them. I started them in high school, and it was one of those things that it took him so many decades to finish. I think it's 7 books and 6,000 pages or something like that.
Oh,
So it
wow.
was also kind of neat where I read the first book when I was probably 16. And then I read the last book when I was maybe 35 or 40. And it was just kind of interesting also because I had changed as a person, just like the characters in the book had.
Mm-hmm.
So
It's
I'm
so
sure there's some
interesting
great
when you,
financial books and all that, but
yeah.
they don't come first to mind. Stephen King does in The Dark Tower.
No, that's great. I love it when you reread something and you have a totally different experience because you have so much more wisdom, or life has gone and hit you in different ways. It's really neat. So thanks for sharing that.
Sure.
All right. Well, that's it. I appreciate everybody's time tonight, and I hope those of you watching the replay enjoy it as well. If anyone has any questions, you can reach out to me, jenniferabi.com, and I'm happy to answer any additional questions that may come up in the meantime, or if you want to revisit your own allocations so that you can stay invested through volatility. Thanks, Jason.
Yes, my pleasure. Thanks, everybody.